Hello, people. Welcome to Millionaire Nation. Today, we will know the entire story of the banking industry fall in the United States.
Asian shares declined sharply on Tuesday as concerns over the health of global financial markets deepen.
Silicon Valley Bank's collapse set off a panic not seen since the days of the financial meltdown of 2008.
Of three banks in a matter of days that are now sending shockwaves across sectors of the economy and raising concerns about the U.S. bank.
The sudden, sensational collapse of Silicon Valley Bank, SVB, which had assets of over $200 billion.
The United States have seen many ups and downs in the banking industry in the past decade. Before going into the whole story, let us understand how a bank typically works. Let us assume you went to the bank to deposit $10,000 into your savings account. The bank takes your money and deposits it in their lockers. Then, with your money, the bank will give a loan to somebody who is in need for around 5 to 6% on average. From that, 1 to 2% is given to you as interest earned, and the bank will take the remaining amount as profit. Banks usually never hold your money in the bank vaults. They will circulate money to generate wealth. Even you can go and check in the bank by withdrawing an amount of more than $50,000. They need at least a week to arrange cash for your money order. The fall of the banking industry will begin when your money circulated by the bank can't be recovered. Let us dive deep and understand all the chain of reactions that will lead to the banking industry's fall. It is divided mainly into three parts: investment in high-risk portfolios, increased list of loan defaulters, no regulation upon the financial system. Coming to high-risk portfolios, banks usually invest your saved amount in real estate, government securities, and commercial and consumer loans. All these investment portfolios are a mixture of small, medium, and high-risk portfolios. Experienced banking institutions have a dedicated team working on investment strategies to get a better outcome. New banking institutions may not have the experience and best team to deal with portfolio investment, so they may become greedy and follow corrupt practices to get maximum return, resulting in money loss. Second, increased loan defaulters. Banks also give loans to people who don't have a good credit history. During the real estate bubble, due to the high demand for real estate, banks offered cheaper loans to people. So many people became interested and took loans to buy houses. But due to the bubble burst, real estate prices dropped, and people were left with no money to pay back their mortgages and became defaulters, which banks claimed as a loss in their financial statements. The same thing is repeating now. Due to the recent virus outbreak, many people lost their jobs, and their source of income stopped. This left them with no money to pay back their mortgages, so banks had no choice but to take the subsidy given by the government and try to write off their loans and accept the financial loss. Third, no regulatory authority. Before that, if you have watched this far, thank you from the bottom of our hearts. If you think we are worth your time, please click that subscribe button to boost our confidence and provide you with more exciting content like this. Also, click that like button so that YouTube understands that you're liking our content. Let us get back to our point. The United States doesn't have a proper banking regulatory body that closely manages and gives input to financial corporations about their investment portfolios. Banks will not be happy to reveal any of their strategies to the government because confidential documents may be breached or a corrupt officer may leak those data to rival banking corporations. These may incur huge losses. So because of all these issues, it is hard for the government of the United States to handle a country's complicated banking industry, but it is trying its level best to tackle the situation and keep a stop-loss. Let us know all the measures that the government of the United States has taken to tackle the situation. The first action taken was the creation of the Troubled Asset Relief Program, TARP, which provided over $700 billion in funding to stabilize the banking industry. The government used this funding to purchase toxic assets from banks, inject capital into struggling institutions, and support the overall liquidity of the financial system. The government also implemented regulatory reforms, such as the Dodd-Frank Wall Street Reform and Consumer Protection Act, which sought to address the financial crisis's root causes by strengthening financial institutions' regulation, increasing transparency, and improving consumer protections. Dodd-Frank Wall Street reform have defined SOPs, which a bank must follow and function. It consists of many things, such as Volcker Rule, which restricts how banks can invest, limits speculative trading, and eliminates proprietary trading. The Federal Reserve also played a crucial role in stabilizing the banking industry by implementing monetary policies, such as lowering interest rates and purchasing assets, in supporting the overall health of the financial system. Overall, we can say that the U.S. government's response to the banking industry fall was comprehensive and aimed at stabilizing the financial system to prevent a deeper economic downturn. But the banking industry is a fragile market because financial companies are playing corporate games with people's hard-earned money due to the rise in technology and competition. The government needs to bring more strong bodies and strengthen regulatory oversight and also increase consumer protections to proceed with banking with a specific financial corporation. That's all for today. If you want to know more about the real estate bubble burst, please click on this hand-picked video just for you. Thanks for taking the time.